Today, folks, these are my top 5 Canadian dividend stocks to be watching into 2026, some of which are trading at just absolute ridiculous discounts. They've been crashing miserably with super high yields that I think are worth buying right now. And then some of these are trading at record highs. They're trading at record highs for very good reasons, and we're going to explore why and see if they're still worth buying and why they're on my watch list here in 2026. So if you're on a path to financial independence, if you love exploring the Canadian economy and the cyclicality of these mega cap companies, consider hitting that subscribe button, and let's get right into this. Now, I've been quite hostile toward the publicly traded real estate investment trust sector in Canada compared to just owning physical real estate, because you went back 15 years ago and you bought a piece of real estate in Toronto. Even though it's kind of correcting right now, we're in a buyer's market, it is not corrected to levels like seen in 2008 during that major financial crisis. However, a lot of the publicly traded REITs, some of which are even trading below their 2008 levels, which just is a sign to me of horrible mismanaged assets, and it just shows kind of some corruption. There has to be some underlying corruption going on, or it just horrible management, right? But at the top of my list of Canadian REITs has to be Canadian Apartment Properties. This has like 40,000 rental units across Canada and into Netherlands, giving you a little bit of diversity there. It is the purest play REIT to apartments, basically, and right now it's trading at like crazy lows. Like, I mean, it's trading for $35 a share, offering a dividend yield right now, a distribution of over 4%. So I want to dive into this a little bit deeper just to see if there is a disconnect between what the market thinks is going on and if there might be some potential value, because analysts think so. I mean, if we take a look at the analysis here, you can actually see that the lowest analyst expected value is $40 with a high of 54, average 47, and here we're at 35. So if we dive into this, the first thing I want to point out to you guys is basically the net asset value. So the net asset value is if they had to liquidate everything they own, pay off their debts, what's the stock worth today? Which, by the way, this is a company with 45,000 suites, guys, and sites. They are down from 63,000. I think they've been selling some of the properties off, consolidating debt, cleaning the balance sheet up through this more rocky period of higher interest rates, which has obviously been the major effect across all these publicly traded REITs. They've just been getting hit pretty hard. But as we'll see, this company's got a pretty clean balance sheet, right? So if we take a look too, they have a 97.6% occupancy. It's been holding pretty strong. But if we scroll down, nonetheless, guys, firstly, just take a look at this, because the NAV trades at $56. Company's current net asset value is $8.8 billion, and their total debt to book value is 37%. So the company is about 1/3 debt to asset value. Most REITs trade at about 50%, some even higher than that. But at $56, you guys, we're talking about a stock right now that's trading at 35. So why does this happen? So publicly traded REITs, because they're exposed to the public markets, we get to decide what the value of the REIT is. Literal shareholders. So if everyone's selling and shorting the stock, you can actually lower the value of the company's public value against its underlying asset value. And in the past, there used to be hostile takeovers of companies that would just shred the company apart and sell it for its parts, because it's worth more in its parts than it is as a publicly traded company, right? So the only reason this happens is because people are expecting values to drop into the future. People are hating on the real estate sector. It's been underperforming tech and everything else. So there's just been this, continual beating up, which typically leads to, again, misrepresented value that could open up opportunity to us as investors out there. And I think this is the potential time, because they've also been buying back shares aggressively. As I've been digging into this, it checks a lot of my boxes when it comes to companies that I think are worth buying. Firstly, their average rent is pretty low, from $1,650 to $1,750 a month. Is historically low, but because they're in basically land, the government in Ontario specifically, they do rental control where they only allow you to raise the rent by like 2% a year. So it's a good thing for this company, because if tenants move out and over time as they get tenants that churn, which I imagine there's some core tenants that are there for a long time, but there's always a percentage churning over, that'll naturally allow this to continue to go up, because I mean the average rent in this country now is like $2,500 a month or something. It's getting pretty expensive, right? Regardless, just take a look at this. So firstly, they bought back 6% of shares year over year. Their distributions are up 4.6% over year. Their funds, basically their FFO, which is what I want you to pay most attention to, their funds from operation, this is like bottom line cash flow that we earn as shareholders, has been flat year over year. So not incredible, but their payout ratio is still below 60%. I mean, the biggest financial institutions in Canada, like the banks, usually hover between 40 and 60% payout ratios. So This isn't a very strong position. As the units that they currently hold, they've been seeing a 3.8% increase in the same property revenue. So all in all, again, you got a company that's buying back shares. The stock is dropping insanely. The revenues be stabilized. They don't got a lot of debt comparably. Again, there's a lot of boxes checked here that if I was an investor in retirement that wanted a diverse portfolio of, properties to collect income, now might be the time to pay attention to Canadian apartment properties, because at the end of the day, I think management is the biggest risk factor to these REITs, and I think this is one of the most well-managed REITs in our country. So moving into the second stock here, Cameco. Now, this has been a subscriber request for quite a while now, and I've been meaning to break it down, but it's taken me a long time to wrap my head around this company because firstly, it's trading at 105 times multiple. What does that even mean? Well, basically, for those that are uninitiated, a PE means that the company doesn't grow or shrink its earnings. It'll take 100 years for you to double your money. Though that isn't always a good indicator to growth, because some companies like real estate, utility, like anything that has a lot of assets or basically a lot of infrastructure involvement, if the infrastructure can go up in value, it could still raise the stock price regardless of earnings, right? And that's how I want you to think about Cameco, because it is the largest uranium company virtually in the world, with some exceptions out there. But look at the analyst expectations here. So if we take a look at analyst insights, let me see if this will load real quick for us here, guys. We can see that the lowest price target's 120, the highest is 165, average 150. And here we are at 126 with nothing but strong buys across the board. So I want to explain to you why this is on a company that has just terrible earnings. I mean, if you look year over year, their earnings are down 15%. On the 9-month ending, they're up 17%, sure. But their earnings are just all over the place, and you can never judge this company based on its earnings. So what do we judge this company on? Well, there's two factors that are driving the current growth in this. Firstly, obviously, the uranium price is going to be the defining factor to its future, no matter what happens, which puts me on edge a little bit. I'm a little hesitant toward commodities in general because they can be very cyclical, and we're in a hyper bull market right now for commodities. And I just don't want to be getting caught in the latter half of that, though I think we're in like maybe the first inning, second inning, if I had to guess, just because, with these AI data centers, the build out of nuclear power plants, we're just getting started and the contracts are starting to roll in. That's what's driving the future growth of this company. Firstly, Cameco has signed a massive deal. Basically, Cameco, Brookfield, and Westinghouse formed a major strategic partnership with the U.S. government in late 2025 to build at least $80 billion worth of new nuclear reactors, primarily using Westinghouse's AP1000 technology, aiming to boost the U.S. energy independence to create jobs and support AI growth, with the U.S. government getting financial benefits from Westinghouse's future profit or potential IPO. This builds on the 2023 acquisition, where Cameco is a 49% owner and Brookfield is a major owner of, bought Westinghouse. So this is a huge defining factor to why the stock has rallied just so damn aggressively. Again, we go back to that stock price here, guys, and you just look at the year to date. I mean, it's up 71%. In the last 5 years, 713%. Oh my Lord. And that isn't even getting the ball rolling here. This company right now, guys, is sitting on roughly 450 to almost 460 million pounds of U3O8, baby. Like, god awful amount of uranium, right? So, and they have a production capacity right now of over 30 million pounds annually. So a lot of production and a lot in reserve. So if you do a bit of math, I mean, at $76 per pound US, might I add, I mean, you're talking about what, 30-40 billion dollars worth of uranium just, sitting in their back pocket. And you're talking about a company right now that's worth $55 billion. So forgetting the earnings capability here, with that recent contract with the U.S. government, the fact that they're sitting on 40 billion dollars worth of uranium at the current prices, I would say the stock is actually trading at a favorable value, and it's probably why analysts are hiking the future value of this company to pretty high expectations. And basically, uranium is expected to have supply constraints, I think, in the 2030. But again, this entire company's value hinges on what happens with the uranium price. So do keep that in mind, because their reserves, this is their version of gold. Cameco is sitting on the uranium gold mine. And in contrast to that, I think it's important to talk about Barrick real quick as well. Barrick's been a real interesting one because it's now kind of rallied back to being one of the largest companies in Canada at $70 billion. And precious metals in general are incredibly fascinating because China's buying up a crap ton of gold. Silver's at 58 an ounce. I don't know how long this bull run's going to last, but this is another defining factor. But Barrick's using this to their advantage, which I find incredibly intriguing. So firstly, let's just see what analysts expect here. If we take a look at analyst insights, we can see that they're trading for around what analysts think is fair value at around 43.80 is the average, currently sitting around $40, a low of 27 and a high of 55. These analysts can only purely base the value of Barrick on what the expectations for gold prices are in the future. And to put it in perspective how hard it is to predict this, I mean, if you went and listened to JP Morgan, they thought gold wouldn't hit 4,100 or 4,000 an ounce until sometime in 2026. And we got there like back in October where it hit 4,300, like crazy numbers, right? And this company, whew, baby, you want to talk about insanity? Their operating cash flow from production was up 105% to $2.4 billion. Free cash flow up 233%, guys. I mean, nothing short of insane. Just their quarter over quarter growth here was 13%. I mean, year over year, up 18% in revenue. Net earnings are crushing it, up 61%. So what they're doing right now is they're using all of this capital that they're just, raking in this new gold rush to pay down their debts. They want to be completely debt free. I think sometime by the end of next year or something like that. Like they have a lot of aspirations in this new bull market. So if it ever comes to an end, they are set up forever. I think Barrick has the real capability if gold can sustain these prices for the first 6 months to a year into 2026 to make it one of the largest companies in Canada and probably surpass $100 billion market cap. Now it is a dividend stock paying a 1.7% yield. I'm not playing it personally, but I am keeping my eye on it just for the pure interest of what happens in the precious metal space. And we're going to finish up with one more commodity stock that I think is worth mentioning, one that I'm very bullish on and one that I'm more comfortable owning over those two, though I think Cameco is that's an interesting play for some speculation into the next year. But Canadian Natural Resources, I think, is actually trading at a great value today. And not only is it a great value, I'm going to explain to you why I think the next earnings might beat analyst expectations. So firstly, the company's trading at a 15 PE, and we can fairly adjust a price to earnings multiple on this because it's a very cash flowing company. Right now, almost paying a 5% yield, which historically is much higher than it has paid in the past, and the stock has been flatlining since roughly 2022. So I think we're getting a favorable value. Let's see what analysts expect here comparable to my bullish nature. Yeah, I mean, they got a high value of 62, a low of 47, and we're kind of in between here at 52 on the bit of the lower end, but most people have a buy rating on this. And the reason that I'm so bullish on this company is because they have been fighting the lower oil prices. Oil's been coming down. You've seen it at the pumps, but their production has been ballooning. If oil even spikes up a little bit, this company's going back to the moon. And I'm suspecting that they're going to do exceptionally well just on their natural gas production, because this is one of the largest natural gas producers in the world, and their production value is going up insane. I mean, they're growing their production value at something like a 20% clip. I mean, look at the barrel of oil equivalent per day went from 1.3 million to 1.54. And you look at the natural gas from 2.1 to 2.5. Guys, like, are you kidding me? Like, that growth is insane. And if you look at their earnings for their net income from 4.96 billion to 5.5 billion is still incredible growth, right? And that's obviously giving us really decent earnings per share growth. But this is on the back of where we've been seeing, again, natural gas prices have consolidated from 2022, so this is why we haven't seen a lot of growth in Canadian Natural Resources. But now with winter coming, natural gas spiking to highs we haven't seen since 2022, the next quarterly earnings heading into the end of this year are probably going to be very reasonable at best. And if it stays elevated here for a quarter, we're going to get some really great earnings. But again, if I zoom my head out of the way here, it really comes down to, gas, right? Because the oil's been kind of stuck down at this $58 a barrel level. And again, this is great for inflation. It's great for the end consumer like me or you that's traveling a lot. But the fact that they're able to combat these lower prices by just a huge production increase, again, I think people are kind of missing the value potential here, and it's going to be going on for a while like this because I think they're at a new phase of some of the highest growth they've ever seen in their company's history, let alone at this scale, right? It's quite exceptional. So it's on my list, and I love it. I get exposure to it through VDY. Unfortunately, these other stocks I'm talking about, you don't really get a lot of exposure through VDY, but this one, however, is one of the top 5 stocks. I mean, it's a $100 billion company in Canada, right? So I'm very glad I get my exposure through VDY, and I think it has some upper potential into the future. Regardless, we got 2 more here. And this one I'm going to beat like a dead horse because I also think it's trading now at discounted values. And that, of course, is Telus. I mean, paying a 9% dividend yield right now, guys, again, the PE ratio is a little bit hard to justify because they have depreciation, amortization cost. But the reason I'm bullish on it now is because I still think we're in recovery mode. And I don't think recovery mode is ending here yet. I think the stock price is just getting hit by short sellers. I think a lot of people, again, it comes back to the same thing with Canadian apartment properties. When you get stuck in a down cycle, people would rather go to where the returns are, and they would rather buy the highs and the expensive realities of commodities, Cameco, chase the future expectations rather than looking at the fundamentals of Telus and saying, hey, look, like, I think there's some misrepresentation here because the company is recovering. People just don't seem to care. But analysts, if we take a look, guys, I mean, a high of 30, a low of 19, and we're at 18 right now, right? Average 22.30. A lot of people not liking this sector at all, and I don't blame them. It's been a pretty crazy hit sector. Regardless, let me explain to you why I still like it. If we take a look at the 9-month ending period, guys, the revenues are flat. They're actually going up slightly from 15 billion to 15.2. Operating income is now up 18%. I mean, the only thing I don't like about this company is the fact they continue to add shares, because if it's that much of a discount, they should find a way to buy back shares, but their cash flow is so tight with the dividend payout, it's not really giving them a whole lot of bleed room here. But I mean, their cash flow, I mean, they're issuing more shares, which is something I just don't generally like to see. But what I want you to look at here is that free cash flow is up 13%, guys. Like, they are seeing a nice increase from 1.44 billion to 1.6. It's likely that this is going to continue over time. Just want you to take a look at the telecom subscribers here that are up 5% year over year. So they're seeing a bigger increase in telecom subscribers, but not in revenue, right? Because I'm sure you see it right now. I mean, I changed my phone plan because there's so many cheap phone plans out there and a lot of competition coming up, really driving down like the revenue growth expectations. But again, eventually we're going to find a leveling off, and I think we're starting to get to that point. But they have a lot of other growth vectors. Firstly, they're building like one of the first sovereign AI data centers in this country that they partnered with, some of the mega cap companies, but they also have healthcare lives covered through their telehealth at 160 million now, up from 76 million this time last year over the 9-month. I mean, you know how incredible that is? Plus, they have a tech sector. I mean, they have Telus security as well. So the company has a lot going on here, but obviously the telecom is the major driver and the huge defining factor to expectations. But regardless, again, guys, I think people are missing the idea that this company is in its recovery phase right now after going through a crazy level of pricing competition, restructuring costs, higher interest rate environment, but all of that slowly getting put behind them, right? So I'm adding this to my short list as well of stocks that I'm highly interested in, along with Canadian apartment properties. I think, these 2 stocks here, they offer pretty good value right now and pretty high yields. Just something to add to your list if you're interested in looking for stocks that are suppressed, because I'm a guy that always is looking for stocks that are beaten down rather than the ones that have taken off quite dramatically, because that's where you get the best bang for your buck once these things start to recover in the future. And finally, this one I find kind of like an in-between. Unlike Telus that has been issuing more shares, I typically like stocks to check a few lists. Like, I like when revenues and cash flows are going up. I like when the company's buying back shares, and I like when they have a pretty good dividend that has a decent, reasonable payout ratio. Telus doesn't check all those boxes, but I think Canadian National Railway does, and Canadian apartment properties, though, we're starting to see a leveling off of those revenues and the decline. I just want to start seeing that shift to when things return, which we get with Telus, right? Regardless, this is a huge company. I mean, it's an $85 billion company right now, paying some of the highest yields in its history at 2.61%. Analysts right now, I mean, let's take a look here, because the stock's gone nowhere in the last 5 years, but analysts think that it could be worth 190 or a low of 135, and we're hitting that low right now. So yeah, I mean, if we take a look, again, I only like this company because it is truly recession proof. These are the massive railways that ship things you cannot ship by truck, chemicals, things that they just won't allow on the roads. And it's one of the major way we move things around Canada, and especially with like the uprooting, thanks to the tariff war, of our entire supply chain. I think the rails are going to become ever more prevalent into the future. And if you take a look at revenues, guys, they are going up from 12.6 billion to 12.8. That is a nice little increase. Net income from 3.3 to 3.4. Again, we're not talking about fast growth here. This isn't like Google or a tech company, but we're not buying it for those reasons. And it did increase the dividend, guys. So So, I mean, it checks all the boxes, and they're not buying back shares as aggressively, but they did buy back a reasonable amount, about $1 billion worth of stock just within the last quarter, but over, the 9 month, not as much as last year, from 2.5 billion to about 1.44 billion. Regardless, we're seeing all the right things being checked. Revenues going up, earnings going up, dividend increases, share purchases. I mean, what more could you ask for out of a company like this, right? So I've been keeping my eye on this one as well, though I haven't been buying it all that aggressively. I think there's some good potential for Canadian National Railway out there for investors that are intrigued. But yeah, they've also done a lot of restructuring as well. I mean, that kind of hit them a bit hard. If we take a look here, I think when I was looking at their employees, I think they show them here, don't they? Carloads, employees at the end of the period. So from 25,400 to 24,300 or 200-ish. So they laid off quite a little bit of their employees year over year as well. Accident rates have gone up a little bit as well. I mean, we're seeing a little bit of an increase in accident rates there, but regardless, I think this is like the Warren Buffett kind of investments, and they're trading down right now, guys. So, if you want to buy recession-proof foundational companies, again, I don't think it's necessarily cheap here, but I think it is fairly valued, and it has fallen off quite materially from some of its highs. I mean, year to date, it's down 5%. Last year, it's down about 10%. These are the stocks that I'm always looking at in Canada. Like I said, I'm always looking for disconnect in values, especially now with the banks running up, commodities absolutely crushing it, guys. You want to be looking at things when no one's paying attention, because as much as I love the commodity space, and Cameco is a very intriguing kind of speculation into that future of AI growth, I like things that have a little bit more foundation, a little bit more concreteness to them, that I don't have to wait for those future revenues to justify what I'm paying for the stock. And I think you're seeing that with things like Canadian Apartment Properties, potentially Telus, though it's not my biggest check mark. And I think favorably valued today, you could say Canadian National Railway and Canadian Natural Resources. Obviously, I'm still going to keep cost averaging into VDY, but my TFSA is going to be able to be topped up next year, and there's some potential that I'm looking at adding some of these stocks that I might not have as much exposure to in VDY as it stands today. But these are just obviously my opinions. They may change over time. But if you want updates, see what my thoughts are, consider subscribing. And I'd love to know what made your short list of interesting stocks in Canada into 2026. But as always, I look forward to catching you in the next one.